Welcome to Note Lab Mode. Today, we are following the money. We're talking tens of billions of dollars pouring into artificial intelligence, and we're going to figure out where it is really going. This explainer is sponsored by OutfitAlliance.com, which is a really cool service that helps you shop the styles of your favorite influencers. All right, let's get into it. Okay, so let's just start with a number that's kind of hard to wrap your head around. In just the first quarter of 2025, venture capitalists dumped a record-shattering $73.6 billion into AI and machine learning startups. That is by far the highest quarterly total ever recorded. And to put that in perspective, the PitchBook report we're breaking down today points out that AI is snagging 1 out of every $4 that venture capitalists are investing globally. You know, it's not just a big deal anymore. For a lot of investors, it's becoming the only deal that really matters. So where is this mountain of cash actually going? Well, you might think it's just one big flood of investment, but it's not. The data shows a really clear divide. It's like a tale of two very, very different kinds of AI companies. On one side, you have the horizontal platforms. So think of these as the titans, right? A handful of giants building these massive general-purpose AI models and all the infrastructure that everything else runs on. And then on the other side, you have the vertical applications. You can think of this as a huge swarm of specialized apps built right on top of those platforms, each one tailored for a very specific job in a specific sector, like, say, healthcare or finance. And this is where it gets really interesting. When we look at the data from that first quarter of 2025, the split between the titans and the swarm, it becomes incredibly clear. The numbers tell this fascinating story about where the capital is flowing versus where the deals are actually happening. Okay, so in terms of pure cash, the deal value, the titans, those big horizontal platforms, they just absolutely dominate. They sucked in almost $50 billion in funding. That's nearly 70% of all the money going to a pretty small number of companies. But, and this is a big but, when you flip from dollars to the actual number of deals, the story just completely reverses. Here, the swarm of vertical applications is way out in front, with over 1,000 separate deals. That's more than double what the Titan saw. So this tells us that most of the activity, most of the new companies being created, it's all happening with these smaller, specialized apps. So why? Why the split? Well, it really just comes down to cost. The source material makes it clear. Building a specialized vertical app might set you back, say, $3 to $10 million. But building one of those foundational horizontal platforms from the ground up, we're talking hundreds of millions of dollars. That huge difference in cost is what's fueling this absolute explosion, this swarm of new applications being built on top of the tech that already exists. All of this investment, it all leads to one crucial question for founders and their backers. What's the end game? And that means the exit. That's when a company either goes public with an IPO or gets bought by another company. And when you look at how these companies are cashing out, you see another one of these stark divides. Sure, acquisitions are more common if you're just counting them up, but by value, it is not even close. Those massive IPOs, the public listings, they account for the lion's share of the money. We're talking $21.5 billion. That's 78% of the total exit value this quarter alone. And just to see how much one deal can completely change the game, a single massive IPO from the AI cloud provider CoreWeave valued that company at over $14 billion. Think about that. One event single-handedly defined the entire exit landscape for the whole quarter. Just incredible. So, after this whirlwind tour of AI investing, what should you take away from all this? I know we've looked at a ton of data, but it all really boils down to just a few key points. So here's the story. AI is attracting truly record-breaking amounts of cash, but that money is splitting into two totally different streams. You have a few super expensive titans getting most of the dollars to build the foundational platforms, and because that's so expensive, it's created this huge opportunity for a swarm of leaner apps to build on top, which has led to a boom in new companies. And at the end of the day, for investors, the biggest paydays aren't from selling off these small apps, but from taking the giants public in these enormous IPOs. This whole situation leaves us with a really critical question for the future of the entire AI ecosystem. As these AI titans just get bigger and bigger and start building more features themselves, can this swarm of specialized apps actually survive? Or are they eventually just going to get absorbed by the very platforms they were built on? It's a huge question. Thanks for digging into the world of AI funding with us. If you found this NoteLab Mode Explainer helpful, honestly, the best way to support us is to just share it and subscribe for more. And, of course, a huge thank you to our sponsor, OutfitAlliance.com, for making all this possible. We'll see you on the next one.